Okay, so these are the stock picks for the week of May 18, 2015. As always, we'll be using two websites, free websites, for our technical analysis. They are finance.yahoo.com, interactive charts down here, and we want to switch it to the candlesticks and go out to 1 month. This gives us the daily candlesticks. Then we want to go to stockta.com, put in your ticker here, and we'll get support and resistance levels as well as some other indicators. That's the technical side of things. The fundamental side of things we get through Morningstar. We put in the ticker and it gives us a lot of information on the company itself. So those are the free tools we'll be using. And I'm going to go ahead and get started with the top 5 stock picks for the next week. Here they are in alphabetical order. And we're going to start with a penny stock. I like to put in penny stock so that anybody can play. And what I usually recommend is put like $200 into the penny stock. And if it goes up 20%, you've probably made your money back based on commissions. Think of it as just playing around. If you've never played with stock before, you could have to get permission from your brokerage to play penny stocks because they're quote unquote risky. But if you're only putting in a couple $100 to see how it works and see if you can make profit from them, there's really no risk involved. So I'm going to go ahead and make the recommendation of AWGI. I'm going to show you why in a minute here. Of course, if you have a lot of money to put in penny stocks, you can make a portfolio of penny stocks and make quite a bit of money. Alright, so AWGI here is a relatively new stock. You can see it doesn't have much trading. Well, I think there's a problem with this chart. Anyway, it doesn't have much trading volume, but it is interesting because if you see this red line, hey, why is there a red line here? Alright, we're going to go ahead and look at stockta.com. AWGI. What we're looking at is a stock that is right at it's at 2 cents per share. It's right at the, you can see the green line, support level. Now this support level used to be a resistance level, which means that it was keeping the stock from growing. But now that the stock is at 2 cents, the previous resistance level is now a support level, which means it's going to keep the stock above 2 cents in most situations. In addition, you can see down here there's an indicator called stochastics. It is VBU, which means very bullish. What this is telling us is that the stock is likely oversold. Too many people have sold it or shorted the stock, and it's now below its real market value. So it's going to bounce back up in most circumstances. So what we got is a stock above a support level that is oversold, and the Fibonacci's here look good. You can look into what the Fibonacci's mean later, but here's the point. If we buy in at 2 cents and it hits the next resistance level, which is at 3 cents, that's a 50% gain. So your $200 has become $300, and that's quite likely actually. So if you're willing to put in some money to try out a penny stock, go ahead and toss $200 into AWGI. Wait for it to hit 3 cents and then get out. You've made $100 minus commissions, so you've probably netted $80 on your $200 investment, and it's probably going to happen within a week or so, which is why these are weekly stock picks. Okay, so that's AWGI. I think it's the only penny stock I've chosen for this week. The next is E-Man. E-Man. What is E-Man? I don't know. You can check it out in Morningstar. Here's the point. You see this big green bar right here? This means there is a huge amount of trading on the 16th, on Friday. The stock is very bullish, which means that it was probably oversold before that burst in price. I'm going to go ahead and look at the candlesticks. Candlesticks have statistical patterns associated with them that allow us to make pretty good predictions. Now, when we're looking at a candlestick with a gap here, where there's a big space between the subsequent candlestick and that of the previous day, we are going to look at the volume as well, because the volume plus that gap can tell us what kind of gap we saw, and certain types of gaps have statistical patterns to them that allow us to predict the direction of the stock in the coming days. So here we have what's called a breakaway gap, where the candlestick is outside of the normal trading region. You see how all of these other candlesticks were under 2.37, whereas this candlestick is above 2.37. Plus, the volume is way higher. That bar at the bottom is way higher than all the previous volumes. So statistically, this stock should continue to grow. It's a good time to get in on it. And most people avoid this type of stock because they think, be getting in on it way too late because it's already higher than it's been ever in the past. Why would I want to buy at a high? Well, in this case, buying at a high is a smart idea. And actually, this is a penny stock as well, because literally any stock that is under $5 is by definition a penny stock. So this is also a good penny stock. You can toss in more than $200 because this is probably going to grow in the long term. Generally, when you see a bar like this and a gap, it means there is some good news about the stock, and you can check the news in Morningstar or below down here. So it looks like they filed some financial statements and investors read them and or learned about them and got excited and bought the stock. The stock is probably going to rise in the future. You can see it's up 30%. Most people would say, up 30%, I don't want to get in on this, but this is actually a good time to get in if there's a gap, if there's a breakaway gap. So that's that type of gap that you're going to want to learn how to trade, and I teach that in my gap game plan course if you're interested. The third one is FXI. I think I've traded this one myself in the past. This is a ETF, which means it's a collection of stocks. It's like a mutual fund, and it's focused on the Chinese market. So if you've ever want to get exposure to China in your portfolio, this is a good stock to pick. As you can see, it's a very gappy stock. There's gaps all over the place, which is why learning about gaps is so important when you're playing stocks like this. In this case, what we have is an area gap. So my prediction is actually this stock is going to fall and then rise. So, oh, there's no gap. I'm sorry. Yeah, if it was going to fall, I probably wouldn't have made this choice. It's not going to fall because you can see if you look real closely, you can see there's a line below this candlestick. It's like the wick of the candlestick, but it's below it. This is called a shadow. So there's no real gap between these two candlesticks. But there is a gap between all of these candlesticks and the candlestick on May 4. Usually what's going to happen is that gap is going to fill. Statistically, it's going to fill. So statistically, we can make the bet that the stock is going to rise $1. Now, a $1 gain on an investment of $50.50 is going to be nearly a 20% ROI, which is great. So put some money in here, put a limit order. If you don't know how to do that, just wait for the stock to hit 51.50 and then sell it. But you're going to want to put a limit order at 51.50. You could get 20% ROI on this trade. It's probably going to close within a week because this candlestick is a positive indicator of a bullish trend. Next, we're going to move on to Goro. You might have learned through the news that recently gold has been increasing. If you want exposure to gold, I was looking for a cheap option for you guys, and this is pretty cheap. It's also a penny stock. $3.44 to get exposure to gold in your portfolio through Goro. You can check the details of Goro in Morningstar. But what we're seeing is a decent candlestick pattern, and let's go ahead and look at the other technicals. So Goro is a gold resource company. You also get a dividend, so if you hold on to this stock for the long term, you will get free money, basically. You'll get 3% of what you put in per year. So what are they doing here? They are actually producing gold and silver in Mexico. So this also gives you exposure to silver if you're into that. Generally, when gold's on the rise, it's not always the best idea to invest in gold directly. It's often a better idea to invest in companies that mine for gold. And Goro looks to be a pretty stable and safe investment in that respect. It has a strong support level below it. You see this thick green line, which means that the stock is unlikely to fall under that level. It's unlikely to fall below 3.28 bucks. So if we get on this, we are not exposing ourselves to a huge amount of risk, but we are getting exposure to gold in our portfolio, and Goro is pretty cheap, so should it rise quickly, we can actually get a lot more out of exposure to gold and silver than people directly investing in those two commodities. Finally is PBR. PBR is a huge stock. People trade it quite often, but it's actually relatively inexpensive. This is a Brazilian petroleum company, and as you also know, gold and silver, or gold and oil are two commodities that are on the rise these days. And as oil rises, you want to do the same thing. Don't directly invest in oil, it's risky. Instead, directly invest in those companies that are producing oil or involved with the retail of oil. Generally, producing oil is a better bet, but retail is also okay. So PBR is this Brazilian oil company that allows you to get exposure to oil for cheap. Most of the other oil companies in the US have really expensive stock, like ExxonMobil is close to $100 per share, so you can get a lot more shares through PBR. So PBR is an integrated oil and gas company in Brazil. They produce and explore for oil, which is what we want when oil rises. Now, why this stock now? We have a very good candlestick pattern called a bullish engulfing candlestick, where a green candlestick eats up the previous red candlestick. This is indicative of a coming bullish trend within a week or so. We also have a very, this is the wrong stock. I believe we also have a very strong support level below us. Indeed, we do at $6, but that's quite a ways away from where we are, so that doesn't really matter so much. It just means that we're not going to lose a lot. We might lose 40% if the stock market crashes or oil crashes. But one interesting thing here is that PBR is at a relative high, and again, people, the mantra of the amateur investor is buy low, sell high. A lot of people would avoid a stock that's trading at a high. In fact, we have reason to believe that this stock will continue going upward. We don't see any strong resistance levels above it. Oil is on the rise. We have a good candlestick pattern. So I'm going to say get into this, get some exposure to oil in your portfolio, or even just trade it for the short term. We don't have any yield on this stock, so you can consider it a growth stock. It's more, growth stocks technically are more volatile than stocks with dividends. So this is a good bet if you are bullish on the stock. So again, these are the five stock picks of May 18, the week of May 18, 2015. We found that 3 of them were penny stocks. You got exposure to gold, you got exposure to oil, and you got a gap. I think it was this one. Which one? You got a gap stock that should get you about 20% ROI once that gap closes. That was FXI, I believe. Yes. So get in on those and subscribe. After you subscribe, you will be getting my weekly stock picks as soon as they come out. So please do that. If you have any questions, leave them in the comments section below.